right? So what are the pros and cons of passive and active investing, right? So just to give you some context, the first point obviously is a big diversification advantage. We've always been told, spread your eggs, don't put all your eggs in one basket, etc., etc. So at some level, the whole process, it cuts investing risk drastically, right? And if you, let's say, you can run this simulation, you take a 2 stock portfolio, let it run for, let's say, 10-15 years. Let's say one of that stock goes to zero and the other probably grows at 10%, right? You will still see that this portfolio of 2 stocks, in which one has gone to zero and one has delivered 10% returns over the, let's say, the next 10-15 years, the basket as a whole will still outperform, right? So that's something which sounds a little counterintuitive, but this can still outperform compared to, let's say, if you just invested in one stock, because there you could have ended up either making zero or making inflation beating returns. But if you just put these 2 stocks in one basket and invest, right? So just by spreading yourself thin from 1 to 2 stocks, you are basically probably throwing 60% risk off the table, right? So that's number one. Number two, knowing your time frame is key, which is what we discussed. The second issue, which with the whole active versus passive debate, is investors are now holding folios for lesser time frames, right? Now, as a country, we always like to save tax and find processes to save tax, right? So a lot of times people just end up buying something in the month of March to optimize their ATC, and then they're like, okay, I've saved my tax, let me move on in life. And all of us are guilty of doing this at the early parts of our career, right? If some of you are just starting out our career, don't fall into doing this mistake. So having said that, the mutual funds do have a category called a ELSS, which is a equity linked savings scheme, which basically means that when you invest in these funds, they are equity linked funds. These funds get locked up for 5 years, so you can't redeem them before 5 years. Now the good part is that sort of ensures some discipline, that for 5 years you're not going to sell your money. That's number one. Number two, despite all of that, the average holding period of a folio in India currently is about 2.5 years, right? Which basically means that if there was no ELSS, this number, ex ELSS, this number would probably be 5 months, right? Because we are so hung-ho about churning our portfolios, and this is not just a context which is privy to India, which is unique to India, it's actually a global context. Investors have become more of traders, right? In fact, a big motivation why, let's say, I started the Swing Trading newsletter was also because of all the subscribers that I was doing my webinar series with, or let's say, when I was writing online, a lot of people actually ended up saying that, hey, why don't you do something around trading? Although I don't trade a lot, I personally, if even I have to trade, I do a few scalps here and there. But again, in that Swing Trading newsletter, the nuance that we added was we put fundamental takes, we put filters with respect to volume, so that you're not cut short while let's say unwinding positions or while taking positions, right? So that's the whole objective behind that. So this was an article that came in Business Standard a year ago, where they say that 55% of the retail investors have a holding period of over 2 years. And this was 49% last year, right? Which basically means that 45% of investors that invest in mutual funds redeem their mutual funds in less than 2 years. And this obviously includes everything: debt, liquid, equity, etc. But just to give you some perspective, this again sounds counterintuitive to the process that you're supposed to do, right? So what does one do? Why, let's say, why are we here and why am I talking about passive strategy in general? At some level, I do feel that running a passive strategy kicks the cognitive biases out. And what do I mean by this? So the first bias that we'll talk about is something called a recency bias. So let's say today you buy a stock at 10 rupees. Tomorrow it goes to 20, right? The first instinct you will have is, I'll sell this stock, right? Or let's say you bought something at 20, you'll again sell it at 30, right? But what will happen is, while doing these transactions, while in your head you might feel you've made 10%, 20%, 50%, but a big part of that gets, almost 15% of whatever you make goes into short-term capital gains. Let's say if you do the trade within the day and it's an intraday trade, there's a tax at the highest rate of income in your slab, which could be 50%, if you're an HNI in India, and that gets clubbed as speculation income. Then there are brokerages, STT, transaction costs would roughly take up another 1.5%. So what ends up happening is, because there are these leakages and slippages in the system, while you may feel that artificially you've grown your money, but when you just put these leakages and compound it, you'll see you've actually ended up losing money, right? So that's number one. Number two, which a lot of us face on a day-to-day basis, and maybe even I'm guilty of covering a lot of these companies as people keep telling me, is that when you see a price which is high, right? So psychologically, you don't want to invest in it. Now, we had covered Saregama in our webinar series when Saregama was at around 1300 rupees, right? But the stock had already gone up 4.5x. But the whole purpose of doing that webinar was to give you a perspective about how music streaming works and how the unit economics has suddenly changed the fortunes of all the music labels in the world. Despite that, I received a lot of backlash also for that hey, why are you covering a stock that has gone up 5x or 6x? And yet after that the stock was up 6x, right? So obviously price action cannot dictate what I do or what I do not do. Maybe I got lucky and the stock went up, maybe it would have gone the other way around. But the point is, at a lot of times, because we are so biased or so indexed on prices, there is an anchor in our head which will tell us that hey, this stock is expensive, right? So InfoEdge, obviously all the way from 2000 to 3000 became expensive, right? It became a 4-digit stock, and it went all the way up to 7400. And there were people who read that rally and there were people who were cut short. But yet, today also, despite all the correction, the stock is still at around 3,700, which is still almost 100% above the price that it was a year ago, right? So that bias also kicks in, which gets cut when you look at passive investing. And finally, there's something called sunk cost fallacy. So let's say you bought Yes Bank at 100 rupees, I do make this joke sometimes that are you even an Indian retail investor if you don't have Yes Bank in your portfolio? So the fact of the matter still remains that a lot of us who were, let's say, investors in Yes Bank at some point of time in our lives, and let's say if we didn't sell our stock before the whole restructuring was carried out by RBI, there is a high chance we have about 75% of those shares locked up for 2 years in our demat holdings, right? Now what will happen is, because we see that price, we bought this stock at 200 or 80 or 50 and the price of the stock today is 10 rupees, you will have a sunk cost fallacy, which basically means, let's average down, let's bring our acquisition cost low. And what will end up happening is you will maybe just end up putting good money after bad money, right? So that is a lot of these biases and a lot of these issues get cut when you look at passive investing, right? So what happens in passive investing and why is it, let's say, something that one should look into? So obviously in passive investing, there's no price action. There are just two boring terms, which is NAV and units. All you get to see is what is the NAV of your fund and what are the number of units you hold, right? Let's say you entered today at a NAV of 10 rupees. And let's say this was the worst performing scheme of a category, right? After 1 year, it moves nowhere. After 2 years, maybe the NAV moves from 10 to 11. After 3 years, maybe it goes from 11 to 12. In one certain year, it moves from 12 to 15, right? What has happened is, in your head, you just feel that, okay, I had bought something for 10 rupees, it is now 15 rupees. But in 4 years, your money has grown by 50%, right? Which, if you sort of annualize, the CAGR comes to about 11.5%, 12%. So that, I feel, is a big vehicle in which, despite, even if you don't have the wherewithal, if you don't do a lot of active buying, selling, or try and find the next multi-bagger or try and find the next gem, because a lot of us don't have the bandwidth to do it, right? Because let's say we could have a business that we have to run, or we could have a job that we are doing, but we do know that we want to be involved in the markets because, hey, if we look at inflation numbers, if we see the last historic performance, the markets does give us an opportunity to invest in the long term and passively participate in the growth story that India has to offer.